And joining me now for a closer look on what's playing itself out in that market scene is independent analyst Jimmy Moyaha. Jimmy, a pleasure. Thank you for coming.
Hi, Analyst. Thanks for having me.
All right, Jimmy, let's talk about maybe how markets are taking stock of that US inflation print. The markets were flat at close of business yesterday, actually. So I'm keen to find out what we're taking stock of today.
I think the market has largely expected a print in that range. I mean, we didn't miss estimates by that much. It was 0.1% on either side for headline CPI as well as core CPI. But if you look at the pattern of the information that has come out in the last couple of weeks, starting with PCE data, then going into things like non-farms data and the unemployment data, that was a surprise for the markets to say. We've created more jobs, but the unemployment rate has increased. And I think the sentiment there is just pointing towards the US's or the known narrative around the fact that the US at some point will be cutting rates. We know that alongside this, in between all of this, we did get that testimony from Fed Chair Jay Powell in front of Congress around the policy of the US Fed and where they stand. And it was made very clear that rate cuts are not imminent. They will not be taking place imminently. But the market at the moment is still pricing in about 3 rate cuts, so about 75 basis points or 0.75%, still being priced in at the moment before the end of the year. Now, we're still only in Q1 of the year, so there's still a lot that can play itself out and then unfold throughout the markets. And I think market participants at the moment, we saw that leading up to the data that came out just before the inflation prints, we did see that the dollar did start to weaken quite a bit, giving back against all the majors and against the rand as well. And that seems to have continued at the moment. I mean, if I look at the performance of the dollar at the moment, it is about 1% weaker against the rand, 1% weaker against the Japanese yen, and about 0.1% weaker against the British pound. So if we're looking at all of these numbers, it does suggest that we might potentially see markets start to say, maybe we're going back into risk-on sentiment. Maybe that risk-on approach could be there for a bit of time. But as we said the last time we had this conversation, was there's still a lot up in the air. There's still a lot at play in the form of things like elections and ongoing wars and ongoing tensions and all of that. And that cannot be discounted. That cannot be ruled out from a market perspective. And you're seeing that while there is risk sentiment in the form of things like Bitcoin benefiting from those ETFs being approved, and I mean Bitcoin touching $73,000, breaking above all-time highs of 68,000. So that's a very telling sign that markets are definitely looking for returns, definitely looking for avenues of growth or avenues of positivity. But at the same time, if you look at the gold price, that's also been rallying up on the back of that weaker dollar. So yes, there's a lot that still has to unfold within the markets, but you're seeing that market participants are starting to process data points a little more positively than what we may have seen at the start of the year, because we came into the year with expectations, obviously, and those expectations have not been met. But that is the nature of the markets. It's not what we expect, it's what the market will do, and we will respond in kind. So
I must ask you, Jimmy, how important is this timing of the rate cuts? We know it's inevitable. We know we'll see something in 2024. But I'm wondering, you know, the jitters around the timing, the 3 cuts, 2 cuts, 1 cut, you know, is this the most rational way for markets to be viewing this story?
The timing is going to be critical. Cut rates too late, and you've put the economy under too much pressure, and you could trigger a recession. That's a real possibility. We've seen that markets have been lagging behind in certain indicators, and there is still a concern around that. Cut rates too early and you could send inflation back to where you don't want it to be. You haven't controlled inflation. You have to come back and hike rates all over again, and you've undone all the good work that you've put in having rates higher for longer. So the timing is going to be imperative, regardless of which market you're looking at. It's not isolated to the US. It is South Africa specific as well. Cut rates too soon in South Africa, cut before the US, and the South African picture looks different. When the US starts to cut, our rand weakens, and then on top of that, inflation starts to spur itself out of control. We have elevated pricing. We have to hike rates all over again, undoing all the good work that's been done up to now. So timing is what the central banks are doing, and they'd rather be more cautious and more pragmatic around those rate cuts than listen to you and I as market participants and what we might want to happen.
Very fair. I hear that. Let's get into some company news now. Growth Point out today with I think it's numbers that I think are a little bit disappointing. They saw their distributable income per share dipping there by 8.6%. Keen to get your thoughts on this one. We do know that retail has come under pressure, so Growth Point obviously battling there a little bit. But all in all, Jimmy, property, keen to get your thoughts on how property is faring right now, actually.
Growth Point yesterday was high prop, and yes, dividends per share at the moment or distributable earnings per share is coming down quite significantly. Growth Point has also flagged that they expect full year numbers or full year dividends in that respect to be down anywhere between 10 and 12%. But I think that is a natural cycle if we look at what's happening in the environment. There are elevated interest rate levels, which means there's elevated costs to things, which means consumers might be, and companies as well, from a commercial point, might be reviewing how they interact with their landlords and what they're doing from a landlord policy. It's definitely a different picture, though, from what we saw in the pandemic, where we saw everybody vacating offices and concessions being given by the likes of Growth Point. So remember, they gave those concessions to businesses. Now they have to recoup that money. So it's going to take a bit of time to recover that and to get back to where they should be. But if you compare Growth Point numbers to, Growth Point's flagged that the V&A waterfront is doing exceptionally well for them, and that speaks to a return to travel, a return to tourism, a return to activity at a scale that is much needed in the property space. Now, whether or not the property space itself is in trouble in South Africa, I wouldn't go that far. I think it's a very resilient space. I think it has proven its resiliency, especially through the pandemic. And if you compare with what Hyprop flagged yesterday, Hyprop said one of their major risks and one of their major concerns, alongside consumer under pressure and businesses under pressure, is their anchor tenant, one of their big anchor tenants in the form of Pick n Pay across their group, having some troubles of their own. So thankfully, someone like Growth Point would have flagged something like this for their properties, but they might not have such a big concentration risk associated with that. I think the property space, especially with Growth Point's concentration in Gauteng and then now in the Western Cape, is very centered around businesses coming through to the office. And we've seen guys like Growth Point take a very interesting strategy to say, you might not want to come back to office, but you will have load shedding at home, and we've got generators, and so therefore that's how they're going to draw back. And we've seen occupancies increase, we've seen vacancies decrease on a steady and a gradual basis from a Growth Point perspective, from a Hyprop perspective. So I think the property guys in South Africa have found a way around the challenges that face them where they are able to, and where there are challenges that is beyond their control. Can't really fault them for that, can we?
That reminds such an EOH. I think it's a very interesting one. We've seen EOH go through this a very rigorous cleanup operation under Stephen Van Coll. It really has been something worth watching. But what we are seeing now is a company that's battling to edge out some growth. And I'm wondering what that means, Jimmy. You know, now that it is a clean operation, is it still a profitable one?
Stephen Van Coll and his team have done an exceptional job turning that business around. And I think it's a combination of a couple of things where the business sits at the moment is markets have memories. We've spoken about this before, and what happened in the past has really, hurt a lot of shareholders, and some shareholders have held through that. So I think at the moment the market is less concerned around profitability and concerned around where's growth going to come from. And that's not just an EOH problem. That is a market problem. That is a South African problem. We're stagnating at a GDP level, and companies in South Africa are saying, okay, we've got 1, 2, 3, 4, 5 things in the pipeline, but where is growth and meaningful growth going to come from? We've seen the likes of mining companies look offshore for growth and say, we're going to acquire assets outside of the borders of South Africa because the South African picture is lagging. The South African picture is slowing down our businesses. Now, whether or not EOH has the size of balance sheet to be pursuing such activities is another question, right? That and also, if you do, where do you pursue the activities? You don't want to be too aggressive for the sake of wanting to pursue returns over a 12-month period when you've just spent so much to turn around the business and get it back on the right footing. So from a management point of view, they need to be strategic about capital deployment and strategic about how they go forward from here. And the market might be saying, we want results, we want growth, we want this. But again, if they do it and it doesn't work out, we're going to be the first to go back to them and say, oh, but you didn't think this through. So I think the EOH story has been quite a turnaround story, and we've gotten through quite a bit of difficulties and quite a bit of interesting times. And now it's for them to say, how do we move forward from here?
Well, Jimmy, I'm keen to get your stock pick in a bit, but first I'd like us to reflect on counters that have found favor with your industry peers.
What will it be?
Yeah, so I'm going to buy Nike today. So it's trading just a touch above $100 a share currently. It's really lagged the S&P 500 over the last little bit, and you can really understand why. You know, we're in a macro environment where a consumer discretionary stock like Nike is going to be affected by, you know, less spending power by consumers as higher interest rates and high inflation kind of take their toll. You know, if we do get into a situation where inflation, you know, you can see it is coming down. Yes, it might have missed on this specific print, but I mean, we try not to take one data print, you know, as a trend. And you know, I think we are still expecting interest rates definitely to fall this year. That should lift, you know, create a little bit of a tailwind for the company. It's an incredible brand. A brand gives you pricing power. It's a wonderful Steve Jobs clip that's doing the rounds at the moment, explaining what a brand is and its trust. It's really a little bank account that you know, every time you do something good, you generate trust, and every time you do something bad, you know, it's a withdrawal from your trust bank account. And I think Nike has an incredible amount of trust in its brand, and that's what you're buying when you buy Nike. You're obviously paying you know, quite a decent premium to it for it, because it is such an established company. It does have a couple of issues in China at the moment, but if you compare it to something like Lululemon, which has done very well, Lululemon is significantly more expensive. So for us, Nike hasn't had a run yet. Interest rates falling, US consumers still looking strong. I'd be picking up the stock.
All right. What are you picking up, Rowan?
All right, Jimmy, that was stocks like Nike, but keen to get your favorite counter for today.
I'm looking at one locally and one offshore. From a local perspective, I'm looking at MTN. I know they're under pressure with everything that's happening in Nigeria, but I think they've held well at that 80 Rand level. I think we'll still continue to see them probably under pressure until the Nigeria issue is resolved, but I do see quite a bit of value there. Offshore, I'm looking at Kering, the luxury space. I know LVMH has had a good run. Kering's held at $340 to $400 or 400 euros from that perspective, and I'm looking at the fact that luxury can surprise us.
Well, Jimmy, always a pleasure having you with us. Thank you so much for unpacking the markets today. That was independent analyst Jimmy Moyaha.